What we've seen this week is the Greek debt crisis become more of a debt situation. So the possibility of an immediate and messy Greek exit has been somewhat reduced by the fact that Greece and its creditors have agreed to extend Greece's current bailout for approximately, well, exactly 4 months with some slightly relaxed conditions. Now, what this means is that although the possibility of a messy Greek exit in the short term has been reduced, there is still the potential for conflict and potentially volatility for the euro as the two parties attempt to negotiate a longer term solution. What's interesting in this situation is that there is actually the potential for a compromise. So Greece has shown itself willing to walk back some of the rather aggressive promises that Syriza has made, and there has been some very gentle suggestions that perhaps Greece's creditors could be willing to consider relaxing the fiscal tightness that has been mandated by Greece's creditors. So there's a potential for a compromise whereby Greece enacts some reasonably tough structural reforms in exchange for being able to reduce its fiscal surplus somewhat. Looking ahead, I think now that the Greek debt crisis is not so much of a burning house, attention will turn to the ECB's QE, which will begin next week. Now, asset yields are already extraordinarily low, especially in sovereign assets across the Eurozone. You know, we saw the German 5-year get auctioned yesterday at a negative yield, which is quite extraordinary, really, considering that people are paying the German government to borrow money off them. So I think what will be interesting will be just how far the actual start of the ECB's program will manage to depress asset yields in the Eurozone and how that will affect the Euro and other financial markets. Meanwhile, Janet Yellen, Fed chair, testified to both the Senate and Congress on monetary policy, and she actually came under a bit of heat in terms of recent proposals that the Republicans have made to audit the Fed. And actually, Janet Yellen's own independence was attacked at one stage, with a lawmaker accusing her of essentially leaning a little too far to the Democratic side. So I think the idea of auditing Fed monetary policy is laughable, and Janet Yellen really was quite dominant and commanding in terms of just dismissing that idea out of hand and pointing out that the Fed needs to be independent and that independent central banks are proven to be the most effective means of managing monetary policy. So what this means for Eurodollar is that we've got a more confident and a more vindicated Fed that essentially will continue to pursue its strategy of strategic patience. So what we'll see from the Fed is we will see rate hikes, but we'll see them after we've seen a few more months of consistently strong improvement in those areas that have been very clearly identified by the Fed as being important to its decision making. So Eurodollar is the most traded currency pair in the world. In the last month, it's been trading in a wide but fairly well-defined band, and for the next trend to emerge in Eurodollar, I think we'll need to see the effects of ECB's QE. So will asset yields fall significantly, or will the QE really not depress asset yields that much? And also we'll need to see just how strong the coming months of US job creation and wage data will be.